Maina, of International Financial Center, distinguished guests, good morning. It gives me great pleasure to see a number of friends here. Some of us were here last year, and I hope those from outside Kenya manage to travel nicely. And issues with the Middle East have not interfered in a lot of the travels. Those of you who are traveling, of course, you travel safely with your friends and relatives. Today, we are looking at how to discuss the issue of risk to resilience, driving inclusive financial growth through intelligent regulation in Africa's digital era. Like Ram mentioned this, I think also mentioned, Africa is actually an innovation hub. In fact, today we are not actually an emerging financial market. It's actually an innovation champion, and Kenya stands at the center of the African ecosystem. For 2 decades, we have shaped global conversations in digital finance, mobile money, redefined access, digital payments, democratized transactions, fintech partnerships, and expanded inclusion. Our current rate of financial inclusion in Kenya stands at 25%. That is the whole country, 25%, which by any measure is remarkable. However, this needs to translate to impact to realize the national strategic vision. We have translated this into real-life impact on the life of Kenya. The next phase of financial inclusion will not be driven by accessibility. It will be driven by architecture and increasingly by intelligence. The question before us then is this: how do we design forward-thinking regulatory frameworks that deepen financial inclusion, enable innovation, protect trust, and position Kenya as a globally competitive digital financial hub? Financial inclusion 1.0 was about accounts and access. Financial inclusion 2 should be about financial health, data portability, interoperability, embedded finance, algorithmic decision making, and cross-border digital value exchange. We are moving from expanding access points to engineering ecosystems. A forward-thinking regulation is the foundation of that ecosystem. We do not need reactive regulation. We do not need restrictive regulation. But we need intelligent, adaptive, risk-calibrated regulations. Within Kenya, the national strategy is not merely a technical implementation plan. It is in fact an economic strategy. How is that? We have interoperability, which is supposed to reduce friction, standardization that reduces costs, and then resilience that builds trust in the ecosystem. The migration towards ISO 20022 was especially significant. And this is because it became structured. Rich data is the raw material of modern financial intelligence. And in the AI era, data quality becomes competitive advantage. So with ISO 20022, fraud detection becomes much easier. Compliance becomes smarter compliance. Cross-border integration becomes seamless. And analytics becomes predictive rather than reactive. This is not just about faster payments. It's about building the data rails that drive AI-driven finance. Last year, the Central Bank of Kenya committed to an open banking or open finance framework. This move represents a structural shift. Under the oversight of the Central Bank of Kenya, secure API-driven data sharing enables customers, not the institution, to control financial data flows. This unlocks profound inclusion opportunities. We can get alternative credit scoring for MSMEs, real real-time cash flow-based lending, personalized savings and insurance products, embedded finance within commerce platforms. For financial sector executives, the strategic implication is clear. Competitive advantage will increasingly depend on ecosystem participation, not vertical integration. But open banking also introduces new risks. Data misuse is a potential problem. Cyber security and cyber risks become very, very common. Liability fragmentation between the ecosystem partners becomes a reality. And algorithm bias is becoming a big consideration. So this brings us to AI. Artificial intelligence is no longer experimental in finance. It's actually foundational. AI now empowers credit underwriting. It allows enable fraud detection, AML monitoring, customer engagement, and risk modeling. The opportunities are transformative. AI can expand credit access to teams and customers, detect fraud patterns of invisible humans, predict liquidity stress before it becomes systemic, and optimize capital allocation to underserved sectors. But AI also introduces structural challenges: model opacity, embedded bias, over-reliance on automated decisioning, and concentrating risk in sharing with technology providers. So forward-thinking regulations must evolve from supervising institutions to supervising algorithms and data governance frameworks. This requires AI model accountability standards, explainability requirements, and bias testing protocols. Supervisory technology, or SupTech, embedded within regulations themselves. In the future, regulations will be increasingly algorithmic, and regulators must be as technologically sophisticated as the institutions that they supervise. A new frontier in the financial sector is here with us. In 2025, Kenya passed the Virtual Asset Providers Act. This regulation is just about to be published. The regulations for this are just about to be published. The enactment of these regulations makes a decisive shift in how digital assets are integrated into our financial architecture. The Act and regulations envisions how two of the leading financial sector regulators, the central bank and the capital markets, will work hand in hand, bringing to life a framework for the implementation and regulation of this law. The opportunities for the economy are significant. Regulatory clarity attracts institutional capital in this area. Organization can unlock new funding channels for MSMEs. Blockchain technology will then enable us to develop rails that could reduce remittance costs. Digital asset innovation will position Kenya as a regional hub. And consumers can leverage non-traditional asset classes to raise capital. But the risks are equally material. Consumer volatility and exposure, AML CFP vulnerabilities, cyber and custody failures, and systemic contagion from poorly supervised platforms. In the AI era, digital assets also intersect with algorithmic trading and automation liquidity pools and decentralized protocols, creating hybrid risk environments that traditional supervisory tools cannot fully address. The strategic question is not whether virtual assets should exist. It is how to integrate them responsibly into the regulated parameters while preserving systemic stability. So regulatory capacity, not just regulatory intent, will determine success of this new frontier. To successfully navigate this terrain, we must shift our mindset from risk avoidance to resilience engineering. Resilience means designing payment systems that withstand cyber shocks, enabling AI models that degrade gracefully rather than catastrophically, build redundancy into digital infrastructure, and embed real-time supervisory analytics into the system. The future financial system will be open by design, it will be intelligent by architecture, and collaborative by necessity, thereby requiring that the regulators must then be resilient by regulation. This requires deeper public-private collaboration. Shared cyber intelligence frameworks should exist, joint AI governance standards, and coordination between open banking implementation partners, and sandbox environments for blockchain and AI experimentation, so that the regulators can reasonably be able to understand the risks and ensure that they adequately supervise them. Innovation scales best when regulators and industry move singly. For executives in this room, we have 5 important considerations to actually do. The first one is we should treat compliance as a strategic infrastructure, not a cost center. Second, we should invest in data governance. AI competitiveness begins with data integrity. Third, we should embed ethical AI principles in product design, not post-facto controls. Fourth, we prepare for API-first ecosystems. Vertical isolation will not survive platform finance. And fifth, we should engage proactively in regulatory dialogue. Shape the framework that will shape your future. And as we move on to the competitive environment, Kenya has a rare opportunity to be able to actually win the bid. We already possess a digitally mature population, strong fintech capability, progressive regulatory instincts, and regional economic influence. So if we integrate robust payment infrastructure, open banking standards, and responsible virtual asset regulation, AI governance frameworks, we can divide the model for inclusion digital finance across Africa, not by deregulating, not by overregulating, and only by regulating intelligently. Inclusive growth in the 2020s will not be accidental. It will be engineered. It will be engineered through innovative infrastructure, data portability, AI accountability, digital asset oversight, and deep collaboration between regulators, public and private sector stakeholders. The future belongs to financial systems that are secure enough to earn trust, open enough to inspire innovation, intelligent enough to anticipate risk, and inclusive enough to distribute opportunities across the population. The task belongs to us to design that future. Everybody. Thank you for your attention.